Good afternoon, one and all, and thank you for listening, and thank you to AJ Bell for inviting me. I'm just going to spend a little bit of time this afternoon talking about Asia from a macro perspective, why we think Asia looks quite interesting over the next couple of years after, let's face it, a few disappointing years. A little bit about the comparisons with Asia with the rest of the world. Then talk about dividends, and then a bit about what we're doing in Henderson Far East in terms of the themes in the portfolio. So without further ado, this first chart just looks at the COVID period, looking at three metrics: GDP growth, dividend growth, earnings growth for Asia, USA, Europe, and the UK. And it's pretty obvious from this, if you look at GDP growth, that obviously the COVID period was pretty disastrous, especially for the UK in terms of economic growth, but also pretty awful for the Eurozone and the US as well. Not so bad for Asia. We saw a decline, but it was pretty minimal. And then obviously in 21, we saw the big bounce back. It does make me laugh at times when politicians in the UK talk about the UK being the strongest recovering or growing economy. Well, clearly it is going to be the strongest because it was coming off the lowest base. But it's pretty obvious from those orange lines that actually Asia's been pretty stable. And what I would draw your attention to really is the forecast for the next 2 years. Have I just clicked off the presentation there? Jeez.
Yes, we can see it.
Okay, sorry, I just done it on my screen. Excuse me. So what we have seen in the next few years is that there's virtually no growth in any of the major economies forecasts, and these are OECD forecasts, they're not ours, in their recent announcements. So we are seeing a level of growth, but it's pretty anemic, whereas the growth in Asia compared to the rest of the world looks pretty resilient, at over 4% forecast for the next 2 years. And when you look at earnings and dividends, it's a kind of similar story, although to be honest, I think the earnings picture looks rosier than the economic picture for the Western world. The UK looks very anemic in terms of earnings, but dividend growth is supposed to be not so bad for the UK, and that's probably mainly down to materials and energy, to be specific. But it's probably more interesting, I think, to look at it in terms of a line graph, because when you see a bar chart and you see big declines and then big rises or bounces back, it kind of hides the underlying trend. And the underlying trend, I think, from this is really clear. Nominal GDP, so this is slightly different from the chart I showed you earlier because it's nominal rather than real, but you can see the orange line of Asia ex Japan and the trajectory of GDP growth. It almost didn't happen in that growth trajectory for Asia Pacific, whereas clearly we saw the big sell down and the recovery, but more importantly, it's what happens from here. And 22 is not going to be a great year, 23 not a great year, and neither is 2024. And actually I'd argue with the UK that, to be honest, even 2025 doesn't look that great, especially if some of the policies in terms of cutting back expenditure are delayed until after the election in 2024. Again, not a particularly rosy outlook. On the earnings side, a better picture for the rest of the world. But I would argue again, I think some of these earnings expectations for some of these companies in markets in the US, Europe, and the UK for that matter are probably overestimated. If we do see recessions in the West, then I think expectations for analysts are too high and likely to be downgraded. In Asia, we have that underlying growth, so I have much more faith in that earnings forecast for Asia than I do have in the rest of the world. So what about inflation? I mean, it's the major talking point everywhere, and it's probably the biggest dictator of market direction in the short term. We're almost at the point globally where bad news is good news, i.e. the worst numbers we see in terms of economic growth and the lower numbers of inflation is actually positive for equity markets, because people start thinking about the US Reserve will stop raising interest rates and actually think about pivoting towards reducing interest rates or even more supportive measures. For my mind, I think that inflation in the Western world will remain fairly stubborn this year. And the reason I say that is because core inflation, which is what the central banks go by, is likely to be more sticky than some of the transitory inflation in terms of producer prices, energy prices, or food inflation. Those are likely to subside over time. But the core inflation elements, things like wages and rentals, are much slower to come through into the inflation numbers. As we're seeing in the UK at the moment, we're only start talking about wage increases now, probably why we've got all this industrial action. But we won't really see those increased wages start coming through into inflation until next year. So inflation, I think, in the West has a tendency to be a little bit more stubborn than it is in Asia. And the reason why it's not so stubborn in Asia is because we haven't had the same kind of wage, the pressures on labor and wages. We don't have a labor shortage in general in Asia. Yes, we do have energy, etc., and food price inflation, but we also don't have house price inflation, etc. And you've got to remember that the main part that goes into inflation globally tends to be rentals rather than capital values. And as we know, capital values are falling, but rental prices are still very strong. So my feeling is that we're going to get to a point this year where we'll talk about pivoting to lower interest rates, but actually it may not be a pivot, it may be a pause, and we remain at a point where interest rates are elevated because inflation is stubborn. In Asia, I don't think we have that issue. I think some of that transitory inflation will drop off as food price pressures and supply side pressures ease, and we can start easing interest rates maybe sooner than we do elsewhere. Valuation-wise, Asia's cheap. It's certainly cheap relative to its own history. If you look at price to book rather than earnings, which is a better way, I think, of looking at valuations through a cycle. Asia actually is trading pretty close to its lows that it traded at during the GFC and obviously the downturn of 2015-16. Earnings-wise, we're not particularly cheap relative to history, probably just below long-term averages, and also probably pretty much in line with long-term averages against the rest of the world on the bottom right-hand chart. But again, trading at a discount with an economic environment I believe is far stronger than we see elsewhere, to my mind, offers quite a lot of value at this stage in the cycle. I can't really end on the macro side without talking a little bit about China. China divides a lot of people, and there's been various comments from investors about how uninvestable China is. I don't believe that's the case. Clearly, it's a challenge, and it's a more challenging environment than we've seen in the past, partly because of policies and some focus on state-owned enterprises over private enterprises and common prosperity, and people wondering what impact that has on corporates and whether those corporates are now investable. It's always been the case that when you invest in China, you have to invest alongside the government, not against the government. And that's more the case now than it's ever been. China sets out a policy every 5 years and tells you what its priorities are. It's not a sin to make money in China. I think it's important to emphasize that. But if you make money, you can't do it at the expense of the people or the general population. And if you bear that in mind when investing in China, then there are plenty of opportunities, plenty of innovative companies, both in the state and the private sector, which are trading at valuations which I don't think that we'll see again in the near future. In terms of COVID, the points I've put down on the left-hand side of this slide. People are getting quite excited about the zero COVID policy and the changes towards opening up. I think the direction of travel is clear, but I don't believe the path to reopening is linear. The reason I say that is because I think opening up over the winter period, we know there's going to be spikes in numbers of cases of COVID over that period, and we'll test over the next 2 to 3 months the government's tolerance for the levels of hospitalizations and deaths as they go to a more open policy. They've got a lot of political capital. Xi Jinping's got a lot of political capital invested in his success in keeping deaths from COVID down to minimal levels compared to other countries around the world. And I'm not sure he's willing to give that up yet. As I think we get into the first quarter of next year, the weather improves, vaccination levels increase, hospital infrastructure improves, then I think we start getting to a much more open economy. So the market's maybe got a little ahead of itself in the short term, but I think the potential is obvious. If you look at the performance of China over the last 5 years, it really has been quite dire. The market's halved over the 2-year period from the middle of November 2020. Valuations wise, this is one of the cheapest markets in the world, let alone Asia. Excuse me. And I think for next year, GDP growth that will be they will attempt to find about 5%, maybe higher GDP growth in 2023, and that'll have a positive impact not only on Chinese market but also on the region as a whole. And the last point I want to make is the impact of pent-up demand. Now, we saw that in the UK, we've seen that in Europe and the US post-COVID, that people went out and spent money on things they couldn't do for the previous 2 years. And I think the same thing is going to happen in China. But the interesting thing is we're talking about a level of savings here which is far, far higher than the rest of the world. So if we look at the savings ratios of China, and this is net national savings and gross savings as a percentage of GDP compared to the US and the UK, and it's far, far higher. But if I gave you another stat and said that the amount of cash in bank deposits from the retail sector increased by 44% over the COVID period from the beginning of 2020 to now. And that accounts for about 15 trillion renminbi, or about 2.2 trillion US dollars. Considering the UK economy is worth about 3.2 trillion US dollars, you can imagine how much potential cash could be used to buy products, services and goods if the Chinese fully open up in the middle half of the year. So for dividends in the region, I showed you earlier in the charts, I think dividends are supported not only by the fact that companies are very well capitalized, very low levels of debt, high generations of cash flow. And the other thing that supports it is that payout ratios, i.e. the percentage of profits paid out of dividends is pretty low. What's really important, I think, for income investors is two things. Firstly, you want that income that gets paid you every quarter to be sustainable. The second thing is you want that income to grow. Now, I would argue at this point in time, the outlook for Asia, both in terms of sustainability and growth, looks far better than it does for other economies around the world. Firstly, we are going to have underlying growth, and which will drive not only sustainability, but also allow these companies to grow. And because the payout ratios are so low, I expect that over time, companies will pay out a higher percentage of their profits as dividends. So you've got that on top of the underlying growth. And everyone talks about sustainability in Asia, the dividend culture is not really entrenched. And I would agree with that to a certain extent. But this chart just shows the history of dividend cuts and dividend increases over the last 16 years. And every year, apart from 2008, the GFC, there were more companies raising dividends than cutting dividends in Asia over that 16-year period. So not only is the opportunity still ahead of us, I think, for sustainability and growth, actually the track record isn't that bad either. And I think that sometimes that's underestimated. So finally, in the last few slides, just talk a little bit about Henderson Far East Income. We've been around since 2007 in our current form. We have increased our dividend every year from that point, and we're very proud of that track record. I've got on this slide the dividend yield was 10%. That was in October, and that's based on the current level of dividend being paid out over the next 4 quarters. The dividend yield as of today is 8.9%, and that was fully covered at our full year in August 2022. So an incredibly high level of yield, and we're confident of our potential to continue to pay a very high level of dividend going forward, based on the information I gave you earlier about the level of distribution we're seeing from the companies that we invest in across the region. We trade at a premium and have done for most of that 15-year period, and we've been issuing shares at a premium to NAV as and when demand is there. So the key things that run through the portfolio. We're very positive on materials and energy, and it's not so much about demand, it's more about supply. In both cases, supply has been insufficient in order to drive future growth, especially for green metals and transition fuels. So our focus has been on the industrial metals which will fuel the transition, which is copper, cobalt, nickel, lithium, and that's reflected in some of the companies we own and are listed there. In the same way, we believe gas is the transition fuel from coal to wind and solar. Wind and solar is difficult for us to invest in, tends to be very capex intensive, clearly not much yield, but the gas companies are generating lots of excess cash, and the yields we're seeing here we think are sustainable. And we expect both oil, gas and other fossil fuels to actually be fairly resilient over the next few years, based on the fact that the market demand continues to grow and supply continues to shrink. Financials, we have been pretty positive on the beneficiaries of rising interest rates, although we've started switching that more from North Asia, which is more interest rate sensitive, towards South Asia, which is benefiting from the opening up after COVID, both in terms of domestic demand, but also in terms of tourist arrivals. So we've got banks more now in Singapore and Indonesia, and less so in Hong Kong and Taiwan. We like communication services. This is the backbone of the yield part of the portfolio. Telcos are growth assets in a lot of Asia Pacific, and we are seeing demand, especially for broadband and for data usage, especially in the more emerging economies like Indonesia, etc. And a lot of these companies have, as I say, underlying growth, but also pretty high and sustainable yields. And the last part of the portfolio, which is things we've been adding to recently, and partly it's based again on our beliefs on China, is that the valuations we're seeing in China we won't see again for some time, especially in some of these high quality companies which are beneficiaries of China returning to normality. So we've added things like JD.com, which is an e-commerce platform, Li Ning, which is a sportswear brand. It's the second largest Chinese branded sportswear goods, competes with Nike and Adidas. AIA, which is insurance, and Midea, which is white goods and household appliances. And it's these kind of companies, well-run, good quality companies, which will continue to grow as and when China normalizes. So finally, just to summarize, Asia's had a pretty tough few years, partly because of China. China's dragged the region lower, and we could discuss in questions what the reasons why that was. And the other reason being is the strong US dollar, which has squeezed liquidity in the region, squeezed funds away from Asia assets back to the US in particular, but also to other destinations. And as we think as we come closer to the peak in interest rates in the US, we'll see that dollar strength reverse, which should be positive for flows towards Asian assets. Unlike the rest of the world, China will be easing. There may be some easing in the rest of the world towards the end of next year. Maybe that's a little optimistic, I don't know. But China is easing now, and that's really positive for growth both in China but in the region as a whole. And it can't be underestimated how important China is for exports from the rest of Asia, especially North Asia, but also for tourism. Chinese tourists to Thailand have been missed for a number of years, which is why the Thai economy is in the doldrums. Just a reversal of those kind of trends will be very supportive. Valuations for the region are attractive, and especially compared to other markets when you consider what the underlying growth differences are between Asia and the rest of the world. And the dividends, as a result, are sustainable and likely to grow at least in line with earnings and maybe higher if payout ratios grow. And of course, I'm always going to say that Henderson Far East income may well benefit from these trends. I will leave it there and hand back to Ronan. Thank you.